How does life insurance work with estate planning? And why is it considered such a powerful financial tool for families? In this video, we're going to explore how life insurance fits into an estate plan, the benefits it offers, and how it can make passing wealth to future generations much smoother and more secure. By the end, you'll have a clear understanding of how this strategy can help you and your loved ones. Let's start with the basics. Estate planning is about organizing your assets and making sure they are transferred according to your wishes after you pass away. It's not only about writing a will, but also about minimizing taxes, protecting your heirs, and ensuring financial stability for your family. The challenge is that estates often contain things like real estate, businesses, or investments that aren't easily converted into cash. That's where life insurance comes in. It provides immediate liquidity, meaning cash that beneficiaries can use right away. So, how does this immediate liquidity help? Imagine someone passes away with a house, some investments, and maybe a business. The heirs may inherit valuable assets, but they still need to cover funeral expenses, medical bills, outstanding debts, and legal fees. Without access to cash, they might be forced to sell off part of the estate just to pay these expenses. But if there's a life insurance policy in place, the payout provides instant funds that cover these costs, allowing the heirs to keep the family home or the business intact. Another major benefit of life insurance in estate planning is covering estate taxes. In some countries, estates that exceed a certain value are subject to hefty estate or inheritance taxes. For families with significant assets, this can be a real burden. Heirs may be looking at tax bills in the hundreds of thousands or even millions of dollars. Without cash on hand, the only option might be selling family assets at a loss just to cover taxes. A properly structured life insurance policy can be designed specifically to pay these taxes. This way, the estate passes to heirs without being diminished by tax liabilities. Now, let's talk about wealth replacement. Sometimes in estate planning, part of the estate is intentionally directed towards something other than family, such as charitable giving or endowments. While this can be a wonderful legacy, it reduces the portion left for heirs. Life insurance solves this problem by replacing that value. For example, if someone donates $500,000 to a university scholarship fund, they can take out a life insurance policy for the same amount, ensuring that their children still receive the same total inheritance they would have otherwise. Equalizing inheritances is another smart way life insurance can be used. Picture this. One child wants to take over the family business while the others do not. If the business itself is worth $1 million, simply giving it to one child would be unfair to the others. But with life insurance, the estate owner can provide the business to one heir and leave the others equal value cash payouts from the insurance policy. This avoids conflicts and ensures fairness. Now, what about families that own businesses? Business succession can be one of the trickiest parts of estate planning. A business may be the single largest asset in the estate, and it may not be easily split among heirs. Life insurance can be tied into what's called a buy-sell agreement. This means if the owner dies, the insurance proceeds provide the funds needed for remaining partners or family members to buy out the deceased owner's share. This keeps the business stable, avoids disputes, and ensures the business continues to run smoothly. Trusts are another important piece of this puzzle. A life insurance policy doesn't always have to pay directly to beneficiaries. It can also be owned by or payable to a trust, which gives the estate planner more control. For example, if the beneficiaries are minors, the trust can hold the money and distribute it at certain ages. Or if one of the beneficiaries has special needs, the trust can be structured to provide financial support without jeopardizing eligibility for government benefits. Some families also prefer trusts to spread out distributions over time, instead of giving heirs a large lump sum all at once. And here's another crucial point: taxes. In many jurisdictions, life insurance proceeds are income tax-free to the beneficiaries. That means your heirs get the full amount of the policy, not a reduced figure after income tax deductions. In some cases, especially in the United States, an irrevocable life insurance trust can also keep the payout from being included in the taxable estate altogether. This combination of tax-free proceeds and estate tax protection makes life insurance one of the most efficient financial tools available. So let's recap the main ways life insurance works with estate planning. First, it provides liquidity, so heirs have immediate cash to cover expenses. Second, it helps cover estate or inheritance taxes, protecting the value of the estate. Third, it replaces wealth that might otherwise be diverted to charity or other purposes. Fourth, it equalizes inheritances among multiple heirs when the estate can't easily be divided. Fifth, it protects family businesses by funding buy-sell agreements and ensuring smooth succession. Sixth, it can be paired with trusts for greater control over how and when beneficiaries receive funds. And finally, it provides tax advantages that can significantly increase the value passed on to heirs. At its core, life insurance in estate planning is about creating certainty, fairness, and security. It ensures that your loved ones aren't forced into difficult financial decisions at an already emotional time. It helps protect family assets, reduces conflict among heirs, and allows your legacy to be passed down in the way you intend. If you're considering life insurance for estate planning, it's important to work with professionals who understand both insurance and estate law. Financial advisors, estate planning attorneys, and tax experts can help you design a plan tailored to your family's unique needs and long-term goals. In conclusion, life insurance is more than just protection for your family during your lifetime. It's a powerful estate planning tool that can safeguard your assets, provide for your heirs, and help ensure your legacy lasts for generations. By including life insurance in your estate plan, you're not only creating financial security, but also peace of mind for the people you care about most. That's how life insurance works with estate planning. If you found this breakdown helpful, make sure to like the video, subscribe for more financial insights, and share this with someone who's thinking about estate planning. Thank you for watching.